little details are taken care of, and it's definitely not an easy task on top of running a business, on top of trying to get this all together. So I just, if you see them, let them know that I thank them, because they're not So, okay, we're going to start with our first session on insurance. Nathan Barecki has been supporting the Mobile Stage Conference since its inception. He's just an awesome guy. He really is knowledgeable about our industry. When I first started in this business, I started out as like a DJ, and the insurance that I carried was just such a different type of insurance that's really required for coverages and being able to minimize my exposure to any type of claims or incidents. And so when I started shopping for insurance, I got such extreme quotes, and I think it's really because the people I was dealing with were just categorizing me in a place that I really didn't belong. So upon a lot of search and a lot of questioning and a lot of just, you know, trying to get the right rate, making it affordable for my company and having the right coverage, we stumbled upon Insurance West. And it's NFP now, right? So since then it's become NFP. Are you still going there, Insurance West, at all? It's just...
I still call it Insurance West.
Okay, cool. So we found Nathan, and he was just so knowledgeable about the business, you know, and it really is a niche business. And when you find somebody who's really knowledgeable about the business, the coverages make sense and the premiums make sense. And so when we decided that we were even going to start the conference, we were like, hey, you know, this is a really important component, because we all have equipment and we all travel all over the place and we're putting ourselves out there, and if we're not covered properly, it could be a big problem. So with that said, I'd like to introduce Nathan. Give him a big round of applause. Thank you, Nathan, for being here and sharing your expertise year after year.
Thank you for having us and putting this on. It's been great. So, all right, everybody. My name is Nathan Barecki. I work at Insurance West, or NFP now. NFP is probably, I think, the 8th or 9th largest insurance brokerage out there that nobody's ever heard of. So that's how I. So I'm gonna. There's 3 people that buy insurance. There's the guy that just wants a piece of paper that says I have insurance, and he can go on wherever he needs to go and be happy. And I guess he just prays that he doesn't have a claim, because all he has is a piece of paper. He has no insurance for what he's doing. Second person is the guy that kind of cares, and he does a little bit of searching, and he thinks he knows what he's looking for. He's hoping the broker knows what he's doing, and he's got a roll the dice chance. And then there's the third kind of person who actually cares about insurance and wants to protect their business and keep doing their business in the next 20 years, and make sure that if their stage collapses or their building burns down, that they're still going to have a job, still going to have a business, be able to continue working their business. So I get a lot of calls from people, mobile stage referrals, entertainment insurance, and they all kind of go like this. I get the call, hey, I'm looking for some insurance, I got referred over to you, I don't think my broker really knows what we do, I kind of ask him questions, and sometimes I don't get the right answer, or he has to look, and I don't feel confident with it. All right, I can help you out. So I start talking to him, and I hit some key points. What's this? What's this? Do you do sub-rentals? And that blows people's minds. Like, you understand what a sub-rental is? My agent has no idea what a sub-rental is. It's like, what do you mean they don't know? So immediately they're like, okay, you're the guy, you know what you're talking about. Let's do this. Get all the info. A couple days later, get them a quote, and then they look at it and go, yeah, it's a little more than I'm paying now. I think I'm good with what I have. Wait, a couple days ago, you told me your guy doesn't know what he's doing and you don't feel comfortable. That's how that call ends. Next guy gets the quote and goes, oh my gosh, this is like 5 times more than what I'm paying. I could go out of business if I have to pay this. Well, you're going to go out of business with what you currently have if you have a claim, because you don't even have insurance. And then the third person, they're excited and they're like, hey, this is about what I'm paying now and I feel way better with you. Or sometimes, in some cases, they're like, this is cheaper than what I have because they're rated as some high construction rigging company that's doing massive shows with stick-built stages and whatnot. So those are kind of the three people. And then occasionally I'll get the question, I'll be like, well, how do you know this is, what I have is not good? So who here, if you have a stage, a couple $100,000 a year, you do a couple $100,000 in revenues every year, if you're not paying $5,500 a year for your insurance, you don't have insurance. You have a piece of paper that says you have insurance, but you really don't have anything. And so people ask me, well, how do you know this? How do you know that's what it is? Well, so I've been doing insurance for 10 years, only entertainment insurance. 90% of my clients are entertainment related, production companies, equipment rental companies, generator rentals, drip lighting. This guy? Okay. I got you.
Thank you.
My insurance agent, I can do it.
That's a true story. He's number 3. He's guy number 3. He's excited for insurance. He had it. Yeah. So.
Thank you.
So, all I focus on is entertainment insurance. If you ask me to insure your yacht, I'm not even going to touch it. I'm going to say, you know what, Google yacht insurance specialist, because there's somebody out there that only writes yachts. There's somebody out there that only writes food trucks. Whatever it is, there's somebody out there that only does that. And that's the person you got to find.
Really quickly, you just kind of mentioned a few numbers, like, hey, you go a couple $100,000 and so-and-so if you're not. Is there a percentage? Like, right now I think I pay about 1% of my revenue. Well, that's maybe just for my liability or whatever.
Right, liability.
Right, so if you're talking liability, is there a percentage? I think I'm about 1%. Do you think I'm under?
It varies from, there's different factors, but the rate is normally $5 on liability per 1,000 of revenue.
That's a half percent.
Yeah,
Okay, that's interesting. Okay.
about $5 to $7 is probably about what it should be.
So, maybe over.
So you could be over.
Do you ever think about it in percentages, though? Does that make sense?
Yeah.
To do that? Okay, sorry.
That's good. Now I forgot where I was. Thank you.
We're in Florida.
Yeah. All right.
We're talking insurance.
Oh, insurance. Okay, we're good. We're good. Thank you. All right. We don't insure boats. Okay. So again, all I specialize is in entertainment insurance, which I've been doing for 10 years now. So somebody who's not with the mobile stage network anymore is kind of the one that got me into mobile stages. So they were looking for insurance, Mike. They were looking for insurance, and somebody that worked there and was part of the company, his wife did insurance, and they could not find the right insurance for their own company. You would think if your wife is part of your company and she's an insurance agent, that's the way to go. To her, kudos, she was smart enough to realize that she didn't know enough about that kind of coverage and needed to find somebody that specialized in it. So after a while of searching, she found me, and I was like, oh yeah, this is easy, we can put this together. So it was a little bit harder at first because carriers weren't really writing mobile stages, and a lot of carriers are writing them as stick-built stages when they're not a stick-built stage, totally different. So we flew our underwriter out to the mobile stage convention, to LDI in Vegas. Our underwriter who we write these stage companies with has seen them. She stood on the stages. She's watched it being built, taken down. She knows exactly what they are. Most agents have no idea, or underwriters have no idea. And then when it goes further, the claims adjuster has zero idea. He thinks it's a trailer. So when he goes to adjust that claim, he's expecting a little box trailer, not a stage. So he's going to value it as a little box trailer, not a stage. So then that's why I know what the price should be when people ask me. Tell them that story, and I put in the time. I read the policies. I searched for months to find it. I flew the underwriters out. That's how I know that what we have is the insurance that you need, and that it's the price that it should be. So as far as that goes, a lot of people also we see they'll put the mobile stage on the auto policy for damage to the stage. That's not good. On an auto policy, you get actual cash value. So the adjuster, who has never seen a mobile stage before, comes out and is expecting, you know, a $5,000 to $30,000 state or $5,000 to $30,000 trailer, and that's where he's going to start his offer to you guys at. Not $150,000 of the value of the trailer. He's got to go to less depreciation. Let's start it at 30. You got to negotiate up from that and hope that you can get somewhere near what you need. So the trailers, they need to be on the inland marine policy. That way you get full replacement cost. That trailer flips over on the I-90, you get a full check for the value of that trailer. It's also covered worldwide on the inland marine for physical damage to the stage. So if your trailer would have, your stage would have caught on fire,
Government interaction.
Yeah, so the damage to this, it's worldwide coverage. Whether you're pulling it, whether it's in storage, whether it's in California, wherever it's at, it's got full replacement cost value. And that's the proper way to do it. And it's not that much more to do it that way. So that needs to be done. One other big topic is getting your certificates, but more so the rental agreement or service agreement that you have. Everybody, you guys have to have a service agreement with your clients. The handshake does not work anymore. I know I talk to all these old school business owners and it's like, yeah, we've been working with them for 20 years and the handshake is great. And it is great until your stage collapses and kills 5 people. Then that handshake, what handshake? We never agreed to this. The very first thing, if you have a major claim that the attorneys are gonna ask for is the rental contract, not even the certificate. Where's the contract that you have in place that says who's liable for what? If you don't have one, good luck. Production will push that back onto you, and if it's a big production company that's got billions of dollars, you're gonna have to fight that. It's gonna be tough. NFP, Insurance West, we have an attorney on staff that's a free service to our clients that only deal with rental contracts and service agreements. So we have a couple of contracts that we provide to our clients as a free service. All the, at least in California, all the major studios accept. Everybody knows our contract as soon as they see it. Oh, that's an Insurance West contract. It's fine, put it through. If you get pushback, because you will from production saying, hey, I want to redline this, cross this out, X that out, you just send it to our attorney and he'll negotiate it with production and say, okay, we'll take this out, but we're leaving this or changing this. And that's a free service that we offer. That's thousands of dollars of your guys' time getting an attorney and a contract written up. So that's included. It's a good value service that you can take advantage of. But going back, you have to have a certificate and a
Not to
contract.
interrupt, but while you're on the legal action of the attorneys, a lot of times you want to spell everything out. Like one of the things that Fish had mentioned, you know, hey, it's your client's responsibility to give you the name of the local hospital, the evacuation route, and the police person, and all that in charge. And I love that, and I want, because I didn't have that the client's going to read it, not that we're going to follow through on it. But keep it simple, because you put things in your contract that you don't follow through or your client doesn't follow through, then that proves that you're negligent in a court of law when something happens. So sometimes a lot of these contracts are more, keep it simple, the more you're going to protect yourself, what you're doing with them.
I mean, our contract is 3 pages probably in tiny font, but it's related to basically who's responsible for what, and it doesn't necessarily go into action plans. It's sort of a separate deal. I mean, it can be added in, and probably a better attorney question. I would, yeah.
Just one for while we were talking insurance.
Yeah, it's probably good because if it's in there and they sign it, then they're going to be, they didn't read it, well, it doesn't matter. They need to follow the rules of the contract. So those are definitely important. What other questions you guys have?
I know when we were dealing with financing, is there a place you can go, or how do you depreciate the stage on a used one? So say you got a stage 2 years down the road, something happens to it, you say replacement cost. Well, does that mean a brand new stage if yours is old?
Yeah, so replacement cost. So say you buy a brand new $150,000 stage, and 5 years from now it's not worth $150,000.
What is it worth? That's my question.
So Yeah.
You're right.
Well, let's start it up and you'll make money.
That's where I'm trying to see.
So it's going to be scheduled on your policy for $150,000. So 10 years from now, it burns down, you're getting a check for $150,000.
Okay, that's my question.
So it's full replacement cost of what you listed at on the policy.
Okay.
And if the cost of a new one is now increased to 175, you're still getting the 150.
Yep.
So it's not replacement cost.
So it's up to the limit that you have on your policy. Right.
Now there, if you're insuring a stage for $200,000, you're paying a premium of $200,000. If you feel that, hey, you can replace it for $150,000, then buy and pay for $150,000 coverage,
Right.
not $200,000.
So you would need to increase your coverage if the price of replacement cost went up. Sure. Possibly.
So that's you being more aware of what you believe your value is.
Do we, here, we'll go to the slides. I got some pictures. Oh, set it up high. Oh, that's good. So this was the worst claim that I've ever had. That was the equivalent to this stage. It was a Apex 1540, which they no longer make anymore. That stage loaded up with gear, replacement cost was $1 million. My client bought the stage for a job. They were gonna, this company, production company was gonna take it out for 6 months, rent it out. That's what it was planned for. Client buys the stage. The production company that was renting it picked up the stage, took it to Apex to be inspected. Apex says everything's good. They took the stage. My client hasn't even seen the stage yet. Halfway down the road, the driver of the production company, from what it seems like, didn't know how to drive and basically overheated the brakes, and they caught on fire. And you think if you had a flaming trailer behind you, you'd notice it at first. You can go to the next slide. But they didn't, and the entire stage is a heap of metal. Those huge stages take, how long do they take to get? I think he was told about a year before he could get one that size, especially.
Well, that was a model that they're not making.
Right.
I mean, they'll probably go back and reintroduce it in a couple of years, but
right.
yeah, I mean, number 4 is going off the lot. Number 5, 6, and 7 are sold. So yeah.
Okay.
So not only insuring it for the loss, but the loss of use.
Loss of use was huge, and he got paid. So the production company didn't have $1 million worth of coverage for this, so that was already an issue. But they had a contract. He had an awesome contract. He sent it over to us, and we modified it ahead of time because we knew it was going to be a long-term job. We had loss of use provisions in the contract, so he has to go back to production, and he's fighting with them. In the meantime, we turned the claim into our carrier so we could get something, and I think within a couple weeks that our carrier gave him a check for $750,000 to get him back up and running in the meantime while he gets a new stage being built.
I think he's actually getting one this year.
Yeah, he is. He's already, yeah. You can go to the last slide. The last slide is the final.
One thing I had heard on this, not that I'm involved with it or anything, but the street rumors was also when it went to Apex checked the hydraulic business and the stage components. The trailer components, that's your responsibility. It's no different than a boat trailer. You gotta check your greaser axle, check your oils and stuff like that. And that's one of the things that I had heard.
Yeah, from
We gave it a clean bill of health before it left our shop,
right.
but we did not inspect the normal. If we had inspected the axles or the brakes, this, I mean, we could.
Yeah.
This was unavoidable.
It seems like it was driver error for overheating the brakes, not properly knowing how to pull such a large stage. From what we could tell, that was the issue.
It's like a downhill thing, situation. Ride the brakes or something?
Yeah, maybe he was riding the brakes, I'm guessing is probably what happened. But yep, that became the heaping metal. So that's why you have insurance, to pay for that claim. Because if you had that on actual cash value or didn't have the right insurance, can you guys afford to write $1 million check to buy a stage and all the money that you lost for that stage? It was rented out for 6 months on a tour. So it can happen. Sometimes it's like, something like that's never gonna happen. whatever you think isn't the worst, when you have a claim, it's going to be the worst claim ever. It's not the tiny little, I clipped somebody's mirror on the road. Who cares? Just pay for it. Be done. That's why I have it. You flip a trailer, that's why I have it. Not that anybody does that.
Do you do autos and trucks as well, or just?
Yep. So yeah, basically, I started just doing entertainment insurance. So production, grip, lighting, everything, all the equipment. So yeah, we do everything. We do full package. So it's liability, auto, equipment, umbrella policy, workers' comp. We can do health insurance. We do anything, professional liability, errors and omissions.
How specific does your equipment list have to be? Like, for instance, one of the most valuable things in the truck is that trunk full of microphone cables. That's actually more expensive than the mixer. Like, these mixers now are almost getting disposable. It's crazy, the X32s and stuff, and whatever.
So the carrier wants to see a general equipment inventory list to kind of know what they're insuring, but it's an unscheduled policy. So if you have $200,000 worth of unscheduled equipment and your warehouse burns down and you had nothing on rent, you're going to get $200,000. They're not going to go, well, you only have this microphone and this over here, because you guys buy and sell gear all the time and replace gear. If you have something that's really unique, that's over, I mean, I guess it doesn't matter the value, but if you have something that's really unique and real hard to replace now, we schedule it. That way you get that price for it. Because sometimes, yeah, there's something that's hard to get and there's hard to determine the value of it, we can list the value. Other than that, they just want to kind of know what you have, and it's unscheduled. The value will also include under unscheduled sub-rentals. So if you guys are renting from each other, we include that limit, because when you rent it from somebody else, you're now responsible for it. And then you rent it to production, and production's responsible for it. So the owner of the original piece of equipment is third in line, you're second, production's first. But you need the coverage, because if production doesn't have it, you're going to get paid for it. So that gets included in the value, sub-rentals. On the sub-rental, on rented equipment, the policy that we have gives you $25,000 for loss of use. A lot of people have been asking for that. So if your trailer was on a job and it was going to go to another job in 2 days and there's a fire at the job, even if your gear is not damaged, but maybe the whole venue is shut down and you can't get to your gear and you have to go rent it from somebody else, that's still covered. And you're going to get $25,000 built in. If you need more, we can easily get more. That's just sort of what they give you to start with. Other questions?
Tie this together. You're talking about the hardware and the equipment. Can you tie this together with liability a little bit?
I'm sorry.
Liability.
Liability? Okay, so we do two ways. We schedule the trailer on the auto policy for liability, and then it's covered under the general liability. While you're pulling the trailer, it's auto liability. It's a gray line, and in theory, while you're setting up your stage, until it's complete and done, and that's it, it's still an auto liability claim.
What if it's disconnected?
Until it's fully set up, in theory. Now, most of the time, the carrier will cover it under general liability, but if they could say that it's still auto liability. Like, for example, a mattress company. You buy a mattress and they're delivering it to you. If the guy's walking up the stairs and trips and falls on the mattress, that's technically an auto liability claim. It's weird. I don't know why they do it that way, but until the thing is fully done and built, it's auto. So it's important that the trailers are scheduled on the auto policy, because they could try to do some shenanigans and say it was an auto at the time. The stages are kind of new to carriers, so it's sort of a gray line, but we put it on both, so you're covered on both, and you don't have to worry about it. And it doesn't cost you anything.
I'm sorry, Nathan, I had to step away for a minute to handle things with my family,
Yep.
but forgive me if you've already covered this, but it's my understanding that the three primary chapters of the insurance are the general liability during the gig, the auto when it's going down the road, and then force majeure. Is that correct?
The which one?
Force majeure, act of God.
Yeah. I mean, that's under the general liability. If some lightning strikes your stage and catches on fire, then that's going to be a thing. With the contracts too, a big thing is what they, after the full 3 pages of type 6 font, basically what it says is that if you're setting up your stage and you set it up incorrectly, then that's obviously your own fault, and that's what your insurance is for. Your insurance is going to cover it. But if production does something, if some guy decides to go stage diving off of your stage, or somebody at the event gets drunk and runs into it, that's production's fault. Production needs to be watching these people. Even if you're on your stage, that's production's claim. You don't want to get stuck with claims that aren't your claim.
Production or promoter? I am the production, I am the stage.
Sorry, yeah, we have different terms. So it would be the event.
The
event, the venue. Yeah. Now, everybody's going to get sued. The guy that's selling tickets is going to get sued. The hot dog vendor, he's getting sued because somebody fell off your stage. And so the carrier will defend you. They have the defense costs, and then as soon as they figure out that, well, that's not your fault that somebody got drunk and fell off, where's the promoter's security? And then they're going to get stuck with it. And basically that's what the contract says. That you're responsible for your own doing. If it's outside of your control, it's the promoter or the venue. And that's why the contracts are so important.
So you also get into the promoter side of insurance and
Yep.
all that?
Yep. We can do anything entertainment related. Movie production, film.
And what type of limits are you recommending now for the overall umbrella and stuff?
How much money do you have? You unfortunately can't buy enough insurance. The smallest guy who's got, $50,000 of sound gear and goes and sets up a stage, he could go broke buying insurance. The guy that's got 50 stages and a fleet of trucks, you could go broke buying insurance. So you have to figure out what's best. Well, you have to figure out what you can survive. If you have a fleet of trucks and you don't have an umbrella of maybe 4 or 5 million, auto is the most dangerous claim. Auto is where everything happens. These stages don't collapse that much. But the auto is where you have your most common claim. So you're pulling a stage and hit a bus, kids, you're toast. That's why you need the umbrella policy.
So, speaking to an umbrella policy, is that something that us as owners of companies would get above and beyond our liability policy?
Yep. So the umbrella policy, you have $1 million liability on your general liability. You have $1 million on your auto liability, and then the umbrella goes above that, and it's $1 million per limit above that. The cost isn't that expensive. We always say it's a cheap retainer for an attorney. The first $1 million above and beyond what your insurance is probably $1,200, and then it's probably $1,000 above that for each limit. So you can have a $6 million limit for $5,000. It's expensive, but how much can your company afford? Can you pay that $5 million claim if something horrific happens? People are killed. So it's good to have an umbrella policy, at least $1 million. If you have a fleet of trucks, you need more. A lot of large venues require it. Live Nation, I think they want 10 million now for you to step foot on their shows. All the studios in California now require 2 or 3 million. That's been starting. So it's going that way.
I've always thought it'd be interesting to own 2 or 3 companies. And okay, I've got my company that owns the stage. Then I got my company that's going to drive it. Then I've got my company that's going to set it up, and then I got my company that's going to run the sound, and then it's all the same people. It's all me, or and just to separate it out. And the reason to do that is, if someone sues the company that's running the sound or production or whatever, stay away from my equipment. That's a whole different company. There's a contract that I signed with myself or whatever, and I don't know if that's a game that exists. It sounds like a smart game to me, where
it's pricey.
It's a good way of protecting your assets.
Yeah.
But it also will cost you more because now you have that separate insurance for this, separate insurance for that, separate legal fees, separate income tax returns. It's more work,
Like,
but it protects your assets.
right. Correct me if I'm wrong now. The equipment company, let's say, why the hell do they need liability insurance? And you know, I might not be thinking about it correctly. So why do they need liability insurance? Because you're dealing with the event company or whatever the hell you're going to call it. Like the liability is all there, but they don't need. The liability company doesn't need equipment insurance because they don't own any equipment.
So they're renting the equipment from the other company, and if for whatever reason they determine that the equipment wasn't properly maintained, now the equipment company has a liability claim. If that light falls on somebody,
And if everybody tries to figure says, all right, but wait, you made a payment for the sound system out of the stage company. Now they've just married the two together.
yeah. So you can have separate companies for everything, but again, it's really expensive because you're buying a separate policy for everything. The most expensive part of buying insurance, and this sounds dumb, is buying insurance. If you buy $1 million policy, you're going to be stuck with the carrier's minimum premium of $22.50. Then you have a $22.50 on this policy, $22.50 on this policy, or you buy an umbrella for $5 million for $5 grand, and it gives you that additional buffer. But so you can do it, but it is more expensive because you have to buy the coverage. It's cheaper to increase your limits than it is to buy the biggest policy. Mike.
When we talk about like claims and what causes your insurance to rise.
Okay, yeah, that's good. So carriers hate little tiny, what they call a nuisance claim. We have clients other than Mike in New York with tons of vehicles, or you're in a busy city, you're probably clipping mirrors all the time on narrow streets. If you turn in every clipped mirror, the insurance carrier will drop you faster than anything. If you have 3 claims that you turn in a year that are under $2,000, they're not going to renew your coverage because they're not going to do it. It costs them more money to file those 3 $2,000 claims and time than it would to do one big claim. So we've had clients get hit with $200,000 or $300,000 claims and not even have a rate increase because that's the only claim they've ever had. That's what the insurance is for. It's not for turning in for a mirror that you clipped. So that's one way. That will drive up your rate faster than anything. Workers' comp's a little bit different. If you have a claim, it's all based on percentages and loss ratios, so it automatically gets an increase. That's a little bit different. But for liability and auto purposes, yeah, the little claims the carriers don't like. Just the cost of doing business, just pay for the mirror and move on.
Well, like with workers' comp, if you have somebody who gets hurt and has that big claim, that's now stuck with you for like 5 years.
Right.
They say, well, you change company name, but you're still married to that address, and a lot of times you're still stuck no matter what company because you're using that address.
Yeah. So back in
start using labor forces or outside, is there
back in the day, it was because of contractors mainly that would have tons of claims. So they would have a bunch of claims, and then they would just form a new corporation and start over. That's when insurance carriers stopped that. Anybody tied with that what they call the X-mod or their claim report will follow you no matter where you go for those 5 years. So you can't just change the company name and expect it to be a clean start on workers' comp. Or really liability for that matter. If you have a huge claim under sound production and then you open, sound production number 2, they're going to ask if you had prior claims. So that, yeah, you can't really avoid.
As far as work comp, do you have any general percentages you can throw out on that, and then how many different categories in this industry?
That's good. The rates vary from state to state, so that's a little bit hard. And the class code kind of changes from state to state. So we use about 4 different ones depending on the state for basically what they'd consider like sound, group lighting, setup, installation, service, and repair class code. The rate on that, depending on the state, varies from like $4 to $8 per 100 of payroll. So you're going to have that class code. If you have an office with clerical people, you're going to have a clerical class code. The rate on that's like 20 cents. It's super cheap. if the warehouse, if the office person is doing other stuff than just office stuff, they'll get pulled into the higher class code. Even
100% or?
yeah, 100%. The carrier. No, the carriers can't split it up. It's very difficult. So yeah, they'll just put them in the higher class code. If it's once a year the guy goes out because he has to do anything, you could put them in the clerical class. They have coverage. If they fall off the stage, they're covered. The carrier is going to go back and change their rate and make you pay the premium difference. They're covered. But yeah,
Would it make you pay that rate retroactively?
Yeah, they're going to make you.
Or how far back?
1 year.
Yeah, they're going to go back 1 year, pretty much. They can do it. In California, it's really strict. If somebody steps foot in the warehouse, they're automatically a warehouse employee. If they have to walk through the warehouse to get to their office, they're a warehouse person. We had a client who got a huge audit because their offices were in the back. It was cheaper for them to build a dividing wall, like a hallway, through the center of their warehouse to the offices. It's stupid, but that's what they had to do. And it saved them a lot of money. But that's when they get super crazy.
I would say that cost them a lot of money.
What?
I would say that cost them a lot of money.
Yeah.
One thing that has happened to me is I got an insurance audit on my liability policy, and they back billed me and this was like a year later.
Right.
That sort of thing drives me nuts. Because I understand that they deemed that their exposure was different than they thought it would be. But we're beyond that. There were no claims in that period. Why are you coming after me for this? How does that work?
Yeah, so the carriers, that's how the liability premium is based solely, well, in different categories, but for what you guys are doing, based off gross revenue. So you estimate for the year, because you're starting out or you're not sure, you estimate 100,000 and you end up at 200,000. A couple months after the policy, the carrier is going to do their audit and say, well, you did 200,000, we have to go back. Part of the reason is you said you didn't have any claims, but if 3 months from now a claim shows up, they have to cover it. And so they're going to charge you the premium to be accurate. It goes the other way too. If you only did 50,000 in sales, you'll get a refund or a credit.
But now, I said if I did $200,000 worth of stationery, then all of a sudden I get a nightclub and I'm selling them $400,000 worth of equipment. Well, now I got $600,000 worth of sales. I should be paying the liability insurance on the sale equipment.
Right, so that would go into a different class code for sales rather than the staging. And just, if that's going to happen, if you're going to do that, just let us know ahead of time. You can just add it on there.
If I last day of sale, it's like, oh, I made it.
Then yeah, just expect the audit. But let us know, because rather than the auditor coming out and trying to guess, let us tell the carrier, hey, this was all sales of equipment, no installation. They just came in and bought gear. Let's add this class code because the rate's totally different.
Yeah, so $400,000, you may have only made $10,000.
Right. But the rate's really less on that. So.
And I think it's kind of funny. I mean, this is just kind of what I do because I deal with Steve a lot. Steve and I have, tens and 20s of thousands of dollars going back and forth, and a lot of times we like to be like, okay, let's just cancel each other out. Let's keep our numbers lower. I mean, because there's no reason to have revenue. We're shooting back and forth. You pay me 10, I pay you 10. Why? Obviously just keep the numbers lower, and we do that all the time.
I mean, if you're just trading gear.
Right.
Also, if you halfway through, so you can kind of avoid the audit too. If you know, hey, I just told my agent that I'm going to do 100,000 in sales. If 4 months in you get a huge job and you're like, oh, we're going to do 300,000 in sales, we can adjust it, and then you're making payments on the difference throughout the policy term rather than getting hit with your audit. And vice versa, if it's going to be less, say we're having a really, really slow year, let's drop it down. You can adjust it that way too.
Another big question I've had, because I go through audits every year and it's fun. They don't seem to understand that if I have independent contractors and they're not covered, I'm not going to, the guy that does 3 gigs a year for me, I'm not going to make him carry his own coverage.
Right.
That's the point. I'm covering my uninsured independent contractors. That's a simple thing, right? Like
Yeah, so workers' comp, at least in California, and I think it's the same wording in every state. If you have somebody work for you, whether they're a 1099 independent contractor or subcontractor, if they don't have their own policy and provide you a copy of it, and you hire them to do a job, you are now covering them, and that needs to go under. Whether you don't even pay the guy, he gives you, hey, I'll give you these baseball cards. I'll give you my baseball cards if you come work for me for the day. You just paid him, so you have to include that in your workers' comp because they're covered. Because that guy's gonna want to get covered if he gets hurt, and he will be covered. Because under law, the law says anybody working for you is an employee. No matter how you pay them, they're an employee. They might not be on payroll, they might not be a W-2, but they're considered your employee.
Now, what's the difference between a 1099, an independent contractor, and an employee?
How they get paid, it's more of a tax purpose. Insurance doesn't care. If somebody's working for you, they're your employee. They're cool like that.
I'm always wondering how many people here actually have their stages as a separate company. You mentioned that for separating coverage. I'm in a situation where I've got a retail store, and adding my stage is completely blowing up my cost for unrelated business under the umbrella of retail. Does anybody else have that situation where you decided to take the stage and move it separately? And why? Same reasons.
My sound company had a partnership. I started this station company on my own. So I decided to pay a little extra and separate the two.
For insurance, we have a talent as well. So obviously the liability for the talent buying is significantly less than what's required for the staging. So for that reason, we have them as separate entities. Now, I don't know if it's different in Canada, but we actually have both companies actually insured through the same policy though. So I don't know if that's maybe something that's different in Canada versus in the US.
What does the other company do?
Talent buying for like casinos and stuff like that.
So how it works is if you have a corporation or an LLC or an entity that you're using, any business that you do that you put under that, if you own you have a stage company and it stages, and tomorrow your wife's like, hey, I'm going to open a flower shop down the street. Let's just put it under the corporation that we already have, Stages Inc. I'll use it doing business as name, Olive Flowers, whatever. Insurance is insuring that entity, Stages Inc., and every operation that entity has. The carrier's not expecting to insure a flower shop, so in that kind of case, you're going to need two policies. You're going to have to create a separate entity for that other operation. Now, if it's a similar business, we rent stages, we do this, we're also going to sell audiovisual gear, or we're going to do production, like what we'd call film production. That's a similar business that the carriers can combine under the one entity. But under the true policy, whatever entity you're insuring, any operations with that insurance, that you guys are doing is covered under that entity. So you have to let the people know, because Stages Inc. the carrier doesn't plan on covering your flower shop just because you opened it.
And if they did, the flower shop's insurance would be outrageous because they're insuring it at production level, right?
Yeah, they just can't separate it out that way. And it's totally separate, so it's not going to work. Most of the time, too, the carriers that we deal with that are doing entertainment, they don't write a lot of other things. So they're not even going to want to write a flower shop if you went to them separately. More. Got it. All right.
One more question.
Yep.
So one of the things that have been talked about was loss of use and the potential revenues. What do you typically suggest as far as I know we purchase our insurance at the start of the season, so we don't really know what our revenues are going to necessarily 100% be. So we estimate, we try and go like 50% above, and so far that's been the case. But how do you protect yourself from overestimating what you expect your revenues to be for that year, for the
for basically loss of use and whatnot without paying too much.
Right. It's kind of tricky. You have to figure what is going to work for your individual company, really. If you think that it's only going to cost you less than $50,000, maybe the shows that you do are only weekend jobs, right? It's not a long-term job, and you know that if a stage goes down, you know how fast you can get a new one. You're going to have to know ahead of time, yeah, I can rent it from somebody else, or if I buy one, it's going to take 2 months to get, so I need to figure out what 2 months worth of gig rentals would be for that specific stage and cover it that way. It's not that expensive, actually, for the loss of use. You're talking like a couple, like the $25,000 that they give you, in theory, you could remove it from the policy. It's probably like $250 for the year for $25,000. So it's not very expensive to increase that limit.
Thank you.
Yep. Thanks, Mike.
Have a nice round of applause. Nathan Ricky.